good afternoon, or good evening. No idea whatsoever what time you're watching this, but it is 5:13 in the afternoon, July 6th. I hope all of you enjoyed your 4th of July weekend. It's just coming on 5:13 a.m. sunrise over here. And I promised you last week to give you a broader view of everything as we finished off the first half of the year and as we progress into this seasonality portion of July, August, September, and as we head into not only the end of the year, but a bigger, broader, wider view of everything. And I've discussed a lot of this with many of you when we've done one-on-one calls. So what I have for you on screen here is it's simply a projection of time done by a man by the name of Samuel Benner back in 1875, and I suggest go and backtest this and look at the accuracy of his projections of years of hard times, low prices, a good time to buy stocks, corner lots, goods, etc., and hold them until the boom reaches the years of good times and then unload. The years of good times, high prices, the times to sell stocks and value of all kinds, and what he has there as years in which panics have occurred and will occur again. Again, simply a projection, but I suggest that you go and backtest it. It led me to something that was shared with me last week, which is absolutely mind-blowing. And I've shared it with the one or two of you who sincerely embrace the fact that this is a video game and it is very forecastable. The relationship between Earth and Mars, and it is absolutely mind-blowing, and it then still falls into that bigger, broader, wider view, which I have shared with many of you many, many times. So anyway, we will move forward here because where we're looking for now that July 4th and the week of July 4th has ended, a little bit of a recap as to where we're at and how we, not necessarily how we got here, because we knew that we were bouncing off of those 23 minutes that the S&P spent below minus 20% back in April. And I'm going to share with you some seasonalities, like I said, and a few forecasts as far as what we're looking for the bigger, broader, wider view. As far as it comes to day trading doesn't mean anything. Where we're at an hour before the open, we can start to see and project as to where we're headed to. However, I am going to deviate from this really quickly to bring you back to the canary that is whispering in the coal mine. And that is, let me see here, our VIX. And I ask any of you who understand how the VIX works and what the VIX is all about as to why are we up 30% from the April lows on the S&P? Why are we up 30% from the April lows on the IWM? Why are we up 35% on the NASDAQ from the April lows? While the VIX has refused to break down below 1622. You have to be wondering, what is the relationship and why is it that the VIX is not down in the 12s, not down in the 13s, not down in the 14s, but instead continuing to hover around here? And it is because you have nothing but negativity economically, macro factor out there. Nothing but negativity. But none of that matters until it matters. And the black swans only flap their wings once. And when they flap their wings, it's too late to jump out of the pond. So anyway, I will come you off this and bring you back onto the wider view. Because again, what we are looking at here is the basic standard default view of the Dow Jones Index as a daily view. MACD, very bullish. We already knew that. We are, like we have on the S&P and the NASDAQ, that bullish crossover of the 50-day and the 200-day moving average. It is in progress over here on the Dow Jones, and from your basic standard default RSI 14 on the daily, you are into the most significant overbought that you have been to at 75.31 in the better part of 2 years. Bring you on to a trading view of it, but instead of using the Dow Jones, using the ETF, the DIA. Your daily is up at 91.55. 91.55 on your RSI. Again, same thing. Your MACD getting ready to have that bullish crossover, 50 over the 20. Your full stochastics are embedded overbought. Your money flow index, embedded overbought. Very like it is over here at the very end of April, just like it was over here into the peak as we went into the February highs. Embedded overbought. Overbought, overbought, overbought. Bring you on to the S&P. Again, default standard view. RSI 14 on the daily, up at 75.57. Incredibly greater than where we were back in February. Actually, incredibly greater than where we were back in December, which we'll get to later on. The MACD, as it's been basically flatlined, sandwiching from May and June as we churned all through that 2-3 week event into here this June 23 finality, boom, move to the upside for the wave 5. The MACD starting to cross over a little bit bullish, but again, your bullish crossover taking place over there on the 50 and 200. And again, with your RSI being extremely overbought, come over here onto your trading view, looking at the SPY instead of the SPX. And again, you have your RSI 5 up at 91.97. Significantly overbought as we were over here in May, where we only got that fractional little 3.37% dip. And here you are into extreme overbought land. And as you can see, the same on your full stochastics and your money flow. Come on to the NDX, looking at the NDX standard default. Again, RSI 14 over here on the daily, 71.73 with a very small visual sell divergence. MACD sandwiched, bearing downward for the better part of 5 weeks, finally starting to fractionally get across to the upside, with the bullish crossover having taken place right there on June 23 when we had that big spike up and move to the upside, the 50-day crossing over the 200. Come on to a trading view of the QQQ, and you can clearly see a sell divergence on your daily RSI 5 as it's at 79.61. You can clearly see a sell divergence over on your full stochastics, and you can clearly see that your money flow has peaked. And although it is still a very short period of time, you are starting to see a descendance of that money flow from that overbought level. Full stochastics, like I say, embedded overbought, starting to get that crossover to the bearish side, already having that big 50-day, 200-day bullish crossover. And right there where your spike took place, right there towards the end of June as we started to progress here into July. Come over onto your IWM. Unfortunately, Stock Charts doesn't have the Russell 2000, so you have to look at the IWM. And your IWM daily basic RSI 14 up into overbought at 72. Over here at your MACD starting to finally get across to the bullish side, very, very far off behind the Dow Jones from being able to project getting that bullish crossover of the 50-day and the 200-day. Come on to your trading view of RSI, and here's your RSI 5 up at 87.66. Here you are trending on resistance of that 200-day moving average, which finally started to become support at that 213, 214 as we progressed into July. Overbought over here on your full stochastics, extremely overbought on your money flow. And again, these are simply indicators that you can look at to go back to and say, I understand. Coming on to a chart view. And again, I've had to, just because of the way that I do it, I had to already put in there for tomorrow so that I have the right context. Our range, complete crap, complete shit range for the better part of a week and a half as we have been trending here 32, 39, 38. We had 40 on June 30th, 55 there on June 27th, the final Friday of the month. and 39 and 28. And I've shared before, and you can look at your own spreadsheets and see this, that when you start getting that range compression, it is another one of the 20 indicators that you use to suggest to you that you have a very high probability that you are placing a very significant top and you are due to get yourself a half decent decline. What I am going to be doing over the next couple of days is projecting where is your minus 3% level and only where your highest 23.6 retracement level is, because these are going to be your first bullish warning signs. So we've got 60.96 at the moment, 61.62 for your 23.6, and if we were to get a 23.6 retracement to the April 21 lows, we'd be looking at 6,005. So 6,100, 61.60, that's your downside for the moment, and you're pretty familiar with this 61.74, 61.78, 61.88 having been the lows over the course of last week. One close below 6,200. One paid, but it worked. On your QQQ, again, your minus 3% level now at 540, minus 5% at 529, because you do get a little bit more volatility on the QQQ than you do on the SPX. But again, over here, seeing how we have moved to the upside, none, not one, no plus 1% days. I apologize, I was wrong. We did have a plus 1% there on Friday or Thursday where I was not there. The half day, we're up 8.15% on the year. Bring you back to the SPX. We ended the month of June plus 5.11% on the year. We are now plus 6.37% on the year as of the close there on Thursday, July 3. We are not bullish. We are not bearish. We are relatively flat, as we have basically gone nowhere for the course of the year, despite the moves that we have been able to have. Over on the IWM is a 30.05%, 30% move to the upside, 51.60 points. What I have here is your minus 3% being 216.63, and you're pretty familiar with that being broken already with the lows of the last week being 215.39, 214, and 217.36. So that is your primary downside, as the IWM was able to go green on the year as of the close there on Friday, closing just above that 222.93. So where are we? Well, where we are, first and foremost, is the new moon. I had to make an adjustment because I was looking for a new moon high. Instead, we had the new moon low over there on June 25. We're heading into July 11th. July 11th being the full moon, where we also get on July 11th, or relatively close to July 11th, CPI. CPI is going to be on July 15th. At the same time, which you already know, which I will find here quickly before we move forward, is we have our Fibonacci turn date. Our Fibonacci turn date being on July 13th. Now, again, having been very new and exposed to this Fibonacci spiral, I'm amazed by the accuracy of it coming off of that February 19th top. The accuracy having been absolutely impeccable as for it. What we have in a sequence is seeing low, high, low, high, low, high, low, high. So I am basing myself with an assumption that this pattern is going to continue to progress, where on July 13th, we should be looking for a pivot low. Not a all-time low, not a massive stock market crash, but following the pattern of low, high, low, high, low, high, low, high. I am looking for a low if this pattern is to continue. Bring you on to other Fibonacci's. And as you can see, if you do go through these and do them yourself from the October 17th, 2024 highs, that pattern does not stay. You had a high, a low, high, a low, high, a low, high, low. And then as we started to spread out, coming off of the 89 days, going on to the 144 days, in there into March 10th, you had another low. And then coming there onto the June 7th of 2025, the highs came on June 16th, fractionally off by a couple of days. bring you on to from the July 16th of 2024 highs. And what this is looking for, again, being how you're seeing, where is it? Highs and lows, pretty much sticking to pattern, with the low being here being placed over on March 6th. Again, the pattern sticking to itself. July 28th being the prime target date for this Fibonacci spiral, looking for a pivot. 377 days since the beginning of where it started on July 16th, 2024. Come on to the December 7th, 2024 highs. It is also looking for July 28th. However, as you see the pattern, low, low, high, both in place right there on the December 12th date. December 16th being a high, then getting a low on the 20th, a high, a low, a high, a low, a high over on April the 30th date, May 8th being the high, July 28th. If this pattern was to continue, it would be looking for there to be a low placed on July 28th. Bring you on here into a shared projection, which I asked permission for, and they were obliged to share it. Looking at this move that we had off of that 57.67 on the SPX back on May 23, which was only a 3.37% dip, the move to this finalization of this final wave to the upside appeared to have been completed as we were heading into Thursday, where Thursday you got your blow off boom up above that. Again, you see your retracements that they're looking at, 60.82, 60.20, 59.58, and this is on the ES. This is not on the SPX. Here is another one, which was, again, asked to be shared because I just simply don't want to do the drawing myself. Looking at seasonality, looking at this wave that we are looking to finalize, which we have been discussing for multiple weeks going way back into May, we are progressing into what could be, on his view, the topping pattern of the wave 5 of the wave 3 of the wave 3, which we only get a fractional little dip, and then we get a spike to the upside, and we finalize with our wave 5 of wave 3 upwards into the 62.90 range, 63.50 range. And the seasonality, looking at this from a big, broad, wide view over 90 years, appears to peak right there in July area. July, end of July, beginning of July. Difference in timing changes. And then you get your dip heading into August, September, October. Looking at it from a seasonality of post-election years, only looking at post-election years, looking back to the .com era, 25 years. You get your dip there in February, March, every year. You get your dip there in June into July. Didn't get our dip in June. Did not get any dip whatsoever in June. And here is your move, topping typically beginning of August, end of July, into your bottom somewhere there around September. This is not a chart talking about prices. This is simply talking about the seasonality of when dips occur. It's all that it is. Looking at it from an odd years point of view. Only looking at odd years going back 20 or 30 years. I don't remember the date I picked. But again, February into March, you get your dip. And here, July into September, October, you get your dip. A tiny little dip there in June, which I did not highlight, we did not get. We did not get any kind of dip over there in June. So obviously, things are a little bit different. Looking at the seasonality of months going back to COVID. Dip February, March. Dip June. Did not get it. And then here, as you see, since COVID, typically tending to top out somewhere around August with your dip heading in there into September. Now, again, don't take this as biblical. You can go back and look at everything and see your seasonality of your highs that we've been placing in July over the past couple of years. This is simply a bigger, broader, wider view using basic standard data, more of a grandfather kind of thing. And then here you have since Donald Trump, 2016. Your February into March, your June swoon, we did not get. And here again, where you typically tend to get your peak July or August, and then your dip into September, October. So again, that's all that we're looking at here is a bigger, broader, wider view of things with the full moon coming up here on July 11th. That ties in together with our CPI. That also ties in together with our Fibonacci spiral, which brings me back into where I am looking for, which is July. I am looking for that dip. I'm looking for that dip to be taking place here in the month of July. It could be a quick dip and then finish off and get bounced immediately 2 days later. I don't care. I seriously don't care. But that's where we're at from an overbought point of view, and that's what we're looking at as far as when we project into this. So I'll bring it on to the charts. Over here on the SPY, again, only having it here because it's simple to look at. It's a lot cheaper to play SPY than it is to play SPX when you're looking at further dated puts. I'm already into the 600 puts as I shared with you early in the week. You have your fake print from June 24th. Your fake print is down here at 588.79. Do what you want with it. But your 23.6 retracements are at 598, 592, and your big exhaustion gap, which everybody is pretty much looking that you'll be getting a dip somewhere in here to the 38.2. 38.2 taking you down to around 571. 571 takes you inside of that gap. That's what we're all looking for, all of us. Come on to the QQQ and looking at the SPX. Looking at the SPX strictly from that dip down to 57.67, which was only a 3.37% dip. The bounce that we have had off of that since May, since we were talking about heading to the upside, possibly heading into the 6200s as we were going to be bouncing, a lot of gaps to be filled, and here we have now touched onto plus 30% from the April lows with this move off of the 57.67 encompassing onto 9% with 1, 2, 3, 4 big 5 gaps to be filled. Another little tiny one here, 6. And I'm pretty sure all of these are adjusted correctly. Yes, they are. 59.42 being the big major downside move possibly to be expecting. Come over onto the SPX, and again, the new moon, I was looking for a new moon top. They failed me out. Here we are with the new moon bottom instead. Trend line that I have here is very interesting. Is the 2015 highs going on to the 2022 highs. And we have now just broken up above it. So are we getting frothy? Are we getting a little bit over exuberant? Absolutely yes. And you're doing it without the participation of your big major players other than Nvidia and Microsoft. Bring you on to the full moons while we're here. And again, full moon, got a nice little full moon top over there in June. Didn't get any kind of recent dip. Tiny little 100-point dip, that was it. This needs to be changed, which I will change at a later date. But we have our full moon that'll be coming in here, coming into around middle of July. Still got another week and a half, 2 weeks before that comes out. On to our projections for this move to the upside that we have been going on since 57.67.41. 1, 2, 3, 4, and here with a very extended impulsive 5. 62.45 was what I suggested was the upside target. And what I loved, absolutely loved, was how they gapped above that on Thursday and never, ever, ever touched it. It gives me that much more confidence for me, because I do this for 30 years, that I'm right. I know I'm right because it's taking my drawings and it is using my drawings. So I'm very happy and I'm very confident about it. And again, to the downside move, it's going to take a little while before you start seeing any kind of a downside move, but still looking at it from that bigger, broader view of a move down here into this, call it 56.65, into that dip zone of 57.20, where the only focus should be 5900 for now. But that's where I'm looking for my dip. My dip down here into the 5700s. Come on to the NDX on a big, broad, wide view of the NDX. Coming off of the January 2023 lows, because you didn't bottom in 2022. We've got a 1-2, a completed 3 as we went in here into February, a big 4, and now where we're working is our final 5. Our final 5 with this reach up here right around to the 138.2, 23.063, another, what, 200 points maybe to the upside, possibly. And then we get our dip for, again, what we're calling this is the bullish wave 1, which does not fit because your wave 3 is your longest wave, and if this is going to be the bullish wave 1 with a wave 2 and then a wave 3, which is going to be the bullish one to the upside, then none of this is actually accurate. And it's been a little bit too accurate the entire time of this progression to the upside. This is our blow-off wave 5. Sorry, guys, but that's what it is. It's our blow-off wave 5. Come on to the QQQ, and again, as I was sharing, 553, 558, 563.50, which very possibly could all be reached, and here we are, right up here, touching onto that 558.71, 563.53 would be perfect, but we're up 38.47%. So again, looking at this for an uncompleted bullish bounce. We've got our 1-2, which was an ABC, ABC. And now here we have our 1, 2, 3, 4, 5. That's the way that bearish waves work. Bearish waves are ABC, ABC, 1, 2, 3, 4, 5. And even though we're putting in a new high, doesn't mean that it is not a bearish bounce. So be careful. Be careful about projecting yourself to be looking at continuing a bullish view when we are not in a bullish trend. All that we have going on is a bounce. That's it. And bring you on to the Dow Jones, looking at the DIA. ABC to the downside, seeing here an ABC to the upside. Not seeing anything significant. ABC for the bounce for the wave 1, wave A, ABC for the bounce for the dip for the wave 2, wave B, and here off of this being a 1, 2, 3, 4, 5 move to the upside and coming right back up into your failure area of that 448, 445, 448, 450, 451 area. I can't, over glorify it, but here we are on the IWM. And again, IWM kind of really thought that we would get that 200-day moving average to work. Didn't work. You got your blow off. You got your green year up 0.07% for the year. Going green up there, 222. And here we are with an extended 1, 2, 3, 4, 5 because the IWM is on a completely different Elliott wave than all the other indexes. That's where we're at. So again, bigger, broader, wider view. Those, where is it? Bring us back here. Yeah. On that July wide view starting points that I sent out, at the beginning of the month, nothing's changed. Nothing whatsoever has changed. All of those dates that we're looking at are for the end of July. All of those dates that we're looking at for the end of July or August or September are simply my suggestion of trades that I am very confident that you would be able to get at least 100% off of. You can change the dates, you can change the strikes, but when I am going to put out a trade of any kind, 32 trade, credit spread trade, I'm expecting that there is a greater than 90% probability that that trade will be able to produce at least 100%, so that if somebody's late, they're able to get in, they can at least get themselves 50%. Somebody can't monitor or they can't watch what they have going on. They can also be able to get themselves somewhere between 70, 100, 120, 150, 200, 233, and once in a while, 400%. We're heading into the end of the month of July. We're heading into earnings. We've got a very slow period here coming in with the next couple of days because we're not into earnings. We're not into any kind of economic data. So we're all subject to waiting to see what is it that Donald Trump is going to tweet next. Unfortunately, that's what it is, and tariffs are coming up on July 9th, middle of the week. We'll go at it as we go at it, and I wish you all the greatest of hangover success from your big long weekend. I hope you all enjoyed the 4th of July. I had the opportunity to have one of the greatest Indian meals in one of the best Indian curry restaurants I have ever been to anywhere on the planet. And it was very interesting to see that the chef was actually hired to cook for Prime Minister Modi privately. So, yeah, one of the best Indian meals I've ever had. Anyway, guys, enjoy yourselves. Enjoy your Sunday. I hope this reaches you well. And if you have any questions, as always, message me. Message me in the chat room or message me privately. Happy to share my thoughts.